Plug Power is potentially in some big trouble in the short term as they recently cut their revenue forecast for 2022 by almost 10%, resulting in an over 45% decline in the share price over the past 1 month. Despite the passage of the Inflation Reduction Act, the stock has come down to the same levels that it was trading at before that bill was passed by the Senate, which is extremely surprising because some of the incentives in that bill are going to directly benefit Plug Power's bottom line and top line. And because this company is one of the leading businesses in the green hydrogen transition, many folks have questions as to whether or not the valuation could be too expensive for the stock, resulting in a potential mediocre return over the next 5 years. And that question is exactly what we're going to address in this video. But as usual guys, before we get into it, make sure to drop me a thumbs up and hit the subscribe button if you haven't already. So to start things off, let's address exactly what Plug Power recently announced with their potential revenue decline based on their guidance for 2022. As you can see, they're expected to grow revenues by still around 90 to 80%, but they have cut their full year guidance by 5 to 10% below $900 million. Now, in a vacuum, I wouldn't typically care too much about a 5 to 10% reduction in guidance because the macroeconomic situation is just developing in the exact wrong direction. I mean, which companies are now going to spend so much money investing in green hydrogen tech when in the short term their main focus is to bring their profitability to the upside as we're witnessing this ongoing recession? But the problem with Plug Power stock is that, as you can see, its valuation is quite expensive at around $17 of a price to sales, meaning that a 10% reduction in the total revenue is going to have a pretty big impact on the way that Wall Street perceives this company. And because Plug Power also recently simultaneously announced that they're going to cut some of their planned green hydrogen plant projects and instead going to focus on a joint venture to build a 15 ton per day plant in Louisiana, really goes to show that a lot of the macroeconomic headwinds are really starting to affect Plug Power's own strategy. But the reality is that this is nothing new. This is something we're seeing across the entire industry. It's just that since Plug Power is a leader in the hydrogen space, where not only do they produce hydrogen, they liquefy it, they transport it, and they also create products that folks can use for that hydrogen in fuel cell forklifts and EV trucks. And because of exactly that, there could be an opportunity brewing in this current decline in the stock price, because the business itself is still on track to execute on a 2025 vision of approaching 40% gross margins and a 17% operating margin. And the really interesting thing here is that even though Plug is cutting forecasts for 2 plants, those plants were not even ground broken just yet. Those were simply projects that were under development and research and would have been executed on if the macroeconomic situation was favorable for that time. And as you can see, according to Plug's own chief strategy officer, their tons per day of green hydrogen production is only going to go down from 70 to 50, which is still pretty significant because obviously there's no other company in the US that produces green hydrogen at such a large scale. And despite this, Plug is on track to hit its goal of 200 tons per day by the end of 2023, which is obviously going to be driven by their latest joint venture with All-In Corporation. But where things are really interesting and where Wall Street is completely overlooking Plug Power is when it comes to the green hydrogen fuel and Inflation Reduction Act opportunity, which is something that right now investors are simply not pricing into the business model. And neither are they pricing in the fact that global economies are indeed shifting towards hydrogen. Some of the most fastest growing industries and economies like Shanghai, Hong Kong, and even China are investing in green hydrogen pipelines and trading platforms because they understand that in the long term, this is going to be the only way to decarbonize heavy-duty industries in a sustainable and cost-efficient manner. Because you simply cannot store enough energy in batteries over a long period of time. You need hydrogen to provide you that range, the recharge time, and the capacity factor to meet your energy requirements. And that is something that Plug Power is obviously working in, not only for light heavy duty, but also back-end energy storage. And to be honest, I think it's best to hear from Andy Marsh, Plug's CEO himself, about the effects of the Inflation Reduction Act, because obviously he has his foot deep in this company over the past 20 years, and he has been working with numerous stakeholders in Europe, Asia, and America to create Plug's hydrogen strategy.
Andy, for potential clients, is the biggest thing holding them back the cost? And is that one of the reasons why this bill could be particularly helpful?
I think cost, it takes it off the table. Now green hydrogen is cost competitive with gray hydrogen. Now green hydrogen can be easily added to natural gas. Yes, I think it is a big driver, which drives a lot of the industrial applications. And in the industrial applications represent 26% of the world's CO2 emissions, which is equal to mobility. It really takes it off the table. We don't have to discuss it anymore. And now we have security. This bill provides a 10-year tax credit for green hydrogen, as well as a healthy tax credit for fuel cells through 2025, which turns to tech neutral after that. So, Plug, and I think the industry, it provides insurance that it'll be around for the long run. So that's why I think folks in both, industrial applications as well as retail applications, as well as mobility applications, are all excited about this bill, and really has changed the landscape for our company and others.
Andy, you mentioned you won't be profitable until 2024. So over the next 15 months or so, where are you going to be investing the most? What areas?
Oh, it certainly is in our electrolyzer and green hydrogen plants. I mean, we've announced we're going to be, investing $1 billion for our green hydrogen plants next year. We're obviously, we've had 2 new factories, one coming online as we speak in Rochester, a gigafactory for making, stacks for green hydrogen plants as well as for our electrolyzers. That's where we're putting the dollars today.
I think it's safe to say Andy hit the nail on the head there. The Inflation Reduction Act is actually going to factually bring down the cost of green hydrogen made from solar and wind to be cost competitive with gray hydrogen, which is typically made with natural gas. And chances are any of the demand that is destructed here in 2022 for Plug's business due to the macroeconomic situation could be pulled forward to 2023 and 2024 because of this act, as more incentives are introduced for companies to invest in products that will leverage Plug Power's technology. You see, the IRA is expected to provide a $3 per kilogram incentive for green hydrogen production, which means that not only is it going to become cheaper than gray hydrogen, but it's also going to spur electrolyzer demand at a fast pace, which is obviously one of the biggest businesses that Plug Power right now is investing in. Now, don't get me wrong, there's still a lot of work that needs to be done to make pipelines more efficient and make them separated from natural gas and methane, which is something that the oil and gas industry can use as an advantage to get these incentives, because obviously using natural gas to make hydrogen is not carbon dioxide negative. But obviously, guys, that's just my take on the situation, so let me know your thoughts about Plug Power down in the comment section below.